want to point out that this webinar is for informational purposes only and does not constitute legal advice. My name is Andrea Johnson. I am the Grant and Financial Education Coordinator for the Office of Consumer Credit Commissioner. Before we get started talking about credit and building wealth, I want to just go over a few things about the Office of Consumer Credit Commissioner. So we license and regulate certain non-depository institutions, and we protect and safeguard consumers like yourself against abusive and deceptive lending practices. We educate consumers and creditors, again like yourself, about their rights and responsibilities. Here are a few of the businesses and industries that we license and register. For instance, we license and register payday loan lenders and pawn shops and manufactured housing creditors. So anytime you have been anywhere down I-35 and you see a pawn shop on the side of the road, the OCCC is there, so to speak. We also provide consumer assistance, which is to protect you from misrepresentation, fraud, and deceptive practices by addressing complaints, providing information about credit transactions, helping you understand the terms of contracts and your legal rights, and mediate disputes. If you have any concerns or complaints, or you know someone who needs to file a concern or complaint with any of the businesses that we license and register, please have them call our Consumer Assistance Helpline, and the number is on your screen right now. We also provide financial education through the Financial Education Coordinator. That's me, Andrea. Informational seminars and webinars like this one. We provide financial education materials, which include the handouts I have today, and you can find those on occc.texas.gov. We provide public service announcements and press releases, and we partner with other education-oriented organizations. And I like to mention this one because as a grant coordinator, I handle our Texas Financial Education Endowment grant. And so every 2 years, we award funds to different organizations across the state of Texas who provide low cost or no cost financial education for K through 12, adults, and financial coaching. And so it's really important at the Office of Consumer Credit Commissioner. So I want to start today with a quick question. Why do you need credit? What do you think is the most important reason why you need credit? Is it to get a job? Is it to get a phone? Is it to buy/rent a house or an apartment? You know, a lot of people might not be aware of all that your credit is good for and bad for, depending on what your credit looks like. So let's see. Out of everyone, for the most of us, we're saying that it's buying or renting a house or an apartment. And that is true. That's very important. But it also helps you get a job, and it can also help you get a simple thing that everyone needs, like a phone. So what is credit and why do you need it? Credit is the privilege of buying services or goods with a promise to pay later. And that might sound like a very easy answer, but the thing is, credit helps you get a job. Credit does help you rent an apartment or buy a home. It does help you get a car, any kind of loan, phone service. It helps you spread out payments. It helps you get credit cards or qualify for insurance. There's so many different things that having good credit affects later down the line. There are 3 different types of credit account categories. There's open, installment, and revolving. Open accounts typically have a balance to be repaid in full every month. Interest is usually not charged, but a provision to charge interest may be included in the initial agreement. The rate usually doesn't exceed 1.5% per month or 18% per year. Company credit cards, some cell phone accounts, utilities, and some retail cards are included in this. And then there's installment loans. Now, installment loans are for merchandise, services, and loans that are repayable in 2 or more regularly scheduled payments. They're secured and unsecured. So, secured means that it will be repaid by putting a lien of credit on an asset you own, such as your car. So, when you walk out of the dealership and you've just financed your car, that car becomes your security for paying your loan. And that's why if you don't pay it, it can be taken away. An unsecured loan is given without collateral, but usually has a higher interest rate. I like to point out student loans, mainly because they can't take your knowledge away from you. So even if you stop paying on your student loan, it's secured because what they're giving you the money for is something that they can't physically take back from you. So revolving credit. Revolving credit requires continuous monthly payments depending on how much of the credit is utilized. Examples of this include credit card accounts, of course. Interest rates typically range from 14% to 30%, and the lower the better, of course, because then you're making lower, you're having lower interest charges per month. And these types of credit usually require a minimum monthly payment, but beware making minimum payments. You may look at it and go, oh, 20, I know one of my cards, the minimum monthly payment is $25. And if I did that, it would take forever to get paid off. But the reason why is, let's say you have $1,000 on a credit card and 18% interest. So each month you make the minimum payment of about $20. And assuming that you don't charge anything else on the card, by the time you get that all $1,000 that was originally charged paid off, you're going to actually pay $1,880. So you've basically just doubled what you owe on that credit card by just paying the minimum. So good credit versus bad credit. What does this mean? Well, to a creditor, having good credit means that you are reliable in paying your bills on time, that companies will be more willing to extend credit to you, and that you may get some lower pricing. Bad credit shows that you possibly are unreliable in paying your bills, even if you had to abandon them because of your financial means changing. You have a high debt to credit ratio, bills are paid late, debts have been abandoned, or you've filed for bankruptcy. And that one's that's not unheard of for someone to have to file for bankruptcy. How do lenders determine your credit worthiness? Well, they're going to look at what we call the 3 C's. This is going to be your character, your capacity, and your capital. Your character is how you've handled past debt obligations. Capacity is how much debt a borrower can comfortably handle. So that's also involving your debt to income ratio. And then capital is your current available assets, such as real estate, savings, and investment that could be paid to repay the debt if you are unable to. So, one thing about someone loaning you money, a business loaning you money, is they are looking to get their money back. And so they want to know how you're going to be able to do that. Another way a lender determines how much debt you can handle is your debt to income ratio. This measures your current financial obligations against your current income. So at 10% or less, you're in great shape. If you have 10% or less in debt compared to your income, you are doing great. 11 to 20%, you shouldn't have any trouble getting loans, but you want to start backing off. Just don't sign up for every credit card that's available. Having good credit doesn't mean that you should just run out and get 50 million credit cards. 21 to 35%, you should probably stop charging. You probably aren't having any trouble getting new cards, but you're probably spending too much of your income on debt repayment, and wouldn't you rather have more money to spend somewhere else on something more fun? Now, when you get to 36 to 50%, you need to develop a plan to get out of debt. Cut up the cards, stop spending, figure out what your cycle of debt is. Credit reporting agencies. What is a credit reporting agency? Well, the definition is that it's a clearinghouse of consumer credit information, maintaining and compiling credit information established by the individual or consumer into a credit report. What does that mean? It means that they're just agencies sitting there taking all this information from you and creditors and putting it into a little nice form for everyone to see and understand if they need it. What is your role? Your role is to establish credit, hopefully good credit history, and also to check your credit file with the credit reporting agency for accuracy. And you can do that for free. not a lot of things in life are still free. So, under the Fair Credit Reporting Act, you're entitled to a fair and accurate credit report. The Equal Credit Opportunity Act prohibits credit discrimination based on your race, color, religion, national origin, sex, marital status, age, or because you get public assistance. The Credit Report Organizations Act prohibits untrue or misleading representation and requires certain affirmative disclosures in the offering of sale of credit repair services. So if you are looking into a credit repair service, there are the Credit Repair Organizations Act is there to protect you. It bars companies from demanding advance payment, and it requires credit repair contracts be in writing. That's a big one. So you're not agreeing to something over the phone, you want it in writing. And again, that's a contract, so you could call the Office of Consumer Credit Commissioner and someone could walk you through that so that you understand what you're looking at. And it gives you certain contract cancellation rights. So that's what that does for you when it comes to looking for a credit repair service. And a lot of people start looking into that. And as we're approaching the new year, that might be something that you or someone you love is thinking about. So how often do you check your credit report? You'll be surprised some of your answers in this little group today. And, do you check it once a year, twice a year, more than twice a year, or never? I myself probably check it way more than once a year. I use a credit monitoring service. And so I like to see what's pinging and why my score is going up or down. And it looks like everyone today, this is really rare for this presentation today. Everyone today is checking their credit report, whether you're doing it once a year or twice a year, you're checking it, and that is important. A lot of times when I ask that question, some people say never. Well, I always think if you say never, is that because you don't think you've had any problems with your credit, or you don't have any credit history, or you're not aware of what could be on there? I had a friend who didn't know until she was over the age of 18, and I think she went to buy her first car by herself, and it found out that her parent had been using her social security number for a really long time, opening bank accounts, buying houses, doing all kinds of stuff, and she had no clue, and she'd never checked her credit report. And so it became a financial nightmare for her. And so it was really hard. First of all, it's really hard to get a new social security number. There's a lot of things you have to do to make that happen. So thankfully, all of us today are checking our credit report, and there are 3 credit reporting bureaus. There's Experian, TransUnion, and Equifax, and you can always get a free credit report by going to annualcreditreport.com. Keep in mind that bureaus, these credit reporting bureaus, they don't make credit lending decisions. That's a myth. They maintain and compile credit information, just like we mentioned. And if something is incorrect, dispute it with a creditor and the credit bureau. So if you go and you see your report and you see that there's something wrong, then you need to check out who it came from originally, and you need to dispute it on both ends, not just the creditor who originally filed it and not just with the credit bureau. So what's in a credit report? Well, personal identification information. So that's going to be your name, your full name, any previous names you've had, your spouse's name. It's going to have your address, any previous addresses you had. It's going to have your date of birth, your employment history, and any employee employment history that you've had. For instance, I went to, I think it was Experian's website one day right before I did one of these, and I just wanted to see how it was going directly to their website. And some of the things, you put in your information and it says, have you lived at, and it shows you different addresses on the screen, and you need to pick which address you've lived at. And when you look at your report, all that information is there. So they're just verifying already up front that the information you're looking for is accurate. It's going to show you account information, which covers your current balances, your payment patterns, and when accounts were opened and when they were closed. It's going to have public record information such as liens, judgments, and bankruptcies, and it's going to have inquiries. And credit inquiries last for 2 years. And that's why it's better, it's the less is more. So the less you have, the higher your points go. What's not in a credit report? Race, religion, medical history, political preference, and criminal record. Your credit report will not show whether you're a Democrat or a Republican, or neither. Credit scores. What goes into your credit score is your credit history, so the longer the better. And for a lot of people, this could be complicated because if you're really young or if you have a new teenager in your life who's going to be stepping out soon, they don't have credit history. And so there are different things you can do to help them establish credit. Another thing that affects your credit score is what is your debt to credit limit ratio. We talked about that a little bit earlier. The lower the better. You know, we talked about the 10%, the 20%, the 36%. So the lower the better, the closer to the 10%, then you're doing excellent. And so that's going to play a role in your credit score. How many inquiries do you have? The less you have, the better. Especially, I think about right now during the holidays, and we're making all these purchases, you know, for whatever holiday you're celebrating. You know, a lot of them all entail giving gifts. And so all these purchases that we're making that we wouldn't normally give, you're going to these companies, they say, sign up today for our credit card and get 20% off, get 0% interest for 36 months, get, you know, 70% off, get 12% off, get $70 off. I think $70 off is Amazon. I always see that one. But, you know, the less you have, the better, because every time you're filling out one of those applications for credit cards, just so you can get that great deal now, it's pinging on your credit report and it's lowering your credit score. And maybe in the new year, you'd rather buy a new house. So, you know, keeping that credit score good would be better. Do you pay your bills on time? So the thing about this is it's not going to be, do you pay your bills on time month to month to month? Because yes, as long as you're paying like your utility bills on time and they're not going into default, those shouldn't show up on your credit report. It's once you've defaulted and you're no longer making a payment and you've let that bill go. That definitely affects your score. Are there charge-off accounts, judgments, or bankruptcies? This is something that's going to affect your credit score, and there are time frames for these things. So you may have filed bankruptcies 7 to 10 years, depending on what it is. Don't expect for things to get better overnight, because a bankruptcy can stay on your credit report for 7 to 10 years, depending on how you file. Credit scores typically range from 350 to 850. The higher the score, the easier it will be to qualify for the best credit terms. I always have a friendly competition with my husband where I am looking at his score versus mine, and I always want my score to be higher. And it usually is, even now, by just 7 points. But those 7 points make a big difference. There are different types of credit scores. There's Beacon, FICO, and Vantage. The one you've heard the most is probably FICO. It's the most widely used. It ranges from 350 to 850. A score of 670 or above is considered a good credit score, while a score of 750 or above is considered exceptional. So if you can get even higher, you know, closer to the perfect 850, you're doing great. Managing your credit inquiries. The fewer the inquiries, the better. Only apply for credit when you need it. When applying for a mortgage or loan, do your shopping in a short time frame and regularly check your credit report. That's probably the most important thing you can do to help your credit. There are different types of credit inquiries, hard and soft. When a lender reviews your credit report to make a decision, this is a hard inquiry. for mortgage, auto, or credit cards. It's considered hard because it is tied to an actual credit application, and it can affect your score. When you check your credit report, and this is, and when people are looking for pre-approval, that's a soft inquiry, and soft inquiries do not impact your credit score. A lot of people want to say, oh, I don't check my credit report because I don't want it to affect my credit score, but that doesn't hold anything against you when you do that. It's better to check it. It actually shows that you're being proactive. If you think about it, you're proactively taking a role in your credit and trying to make it better by checking it. And so the big difference between a hard inquiry and a soft inquiry is a hard inquiry is tied to an application and a soft inquiry is pre-approval. So when you get these pre-approval letters in the mail right now offering credit cards, that's okay. It's once you fill out the application attached to that pre-approval letter and send it back that it becomes a hard inquiry, and that's when it affects your credit score. So this one, if everyone is paying attention today, should be good. Is it good to have several credit inquiries, yes or no? And so hopefully everyone will have the right answer on this because we just went over it. This is a question to see if everyone has stayed awake, right? So it looks like we are on track that it is not good to have several credit inquiries. Someone said yes, rest of us are saying no, probably because the way my question was worded. But the answer is no, it is not good to have several inquiries because that just lowers your credit score. And when a creditor looks at that and sees all these inquiries on your report, they're saying, why are you just racking up the credit? Sorry, I had to mute my mic to cough for a second. So moving on, it takes time for credit to be repaired. Delinquencies remain on a credit report for 7 years. Public record items, 7 years. Bankruptcies, 7 to 10 years. If you're considering a credit repair organization, remember to evaluate the pros and cons. And there are different things. And like I just mentioned, if you do think about doing this and you are going to sign a contract, remember that that contract needs to be in writing, and you can always call the Office of Consumer Credit Commissioner to help kind of walk you through that so you get the right understanding of what you're signing before you sign it. So none of these things when it comes to repairing your credit is an overnight success. I think of it in the sense that when you go to the store and you make a purchase, the money comes out of your account immediately. But when you want to return something, it takes ages to get that money back sometimes. And so the same thing for your credit. It's going to take a while, and we're going to go over the whole dispute process in a second. How to dispute for inaccuracies, a really quick second. If you discover any inaccuracies in your credit report, you need to complete the request for reinvestigation from the credit reporting agency that sent it to you, or send a letter listing each incorrect item and explain exactly what is wrong. If an investigation does not resolve your dispute, you can add a statement to your file of 100 words or less, or contact the creditor. And here is a little flow chart to kind of give you a visual of what this is. So you'll see that first you have checked your credit report and you notice there's inaccuracy. Then you're going to dispute that inaccuracy with the credit bureau. The credit bureau is going to check with the creditor to verify the information. The creditor then has 30 days to investigate and respond. If they don't, the information must be removed. If the creditor does respond, the item will either be deleted or verified. A new copy of your credit report is then sent to you, and you are entitled to a statement of no more than 100 words to explain the negative remarks. So you see this little flow chart kind of gives you a chronological order of how long the dispute process takes. It's not simple. It's not overnight. But I have noticed when you go to the credit bureau's websites, Experian, TransUnion, and Equifax, they actually just have a form right there for you to fill out and send in to them if you need to dispute something. So what can be changed if you find anything that's erroneous? Information that is an error, of course, accounts that are not yours, inaccurate payment history, but you'll need to show proof of this, and any old information. Now, what cannot be changed is information that is true, information within legal timelines. I mentioned bankruptcies. 7 to 10 years, bankruptcies are pretty well known. And so depending on how you file, it determines how long it's going to be on your credit report. And then credit history of payments and your account credit inquiries. So these cannot be changed. Should you place a fraud alert or freeze on your credit report? A freeze generally stops all access to your credit report, and it's available to anyone, and it's temporary until you remove it. A fraud alert, a business must verify your identity before issuing credit, and it remains in effect for 90 days. So one has a time limit and one doesn't. I mentioned this recently. I spoke with someone who has a freeze on their credit report, and they have it there all the time because they were getting credit cards in the mail, she and her husband, that they had not applied for. Actual credit cards, not an application, not a pre-approval letter with, a little fake credit card in it. They were getting real credit cards, and they, did you apply for this? Did you apply for this? And the answer was no. So they turned around and put a freeze on their credit report. They haven't taken it off. What she told me, though, is that thanks to this being on her account, when she goes to make a credit purchase and get a new card, like I mentioned, those too good to be true offers, especially when it's 36 months, no interest, she has to really stop and think, because in order to get that credit card, she is going to have to contact the credit reporting bureau and say, hey, I need to remove the freeze from our credit report so that I can apply for this card. So it kind of gives her a little stopgate for overspending or getting cards that she doesn't really need. There are some credit reporting myths, like the credit bureau denied you credit, which is not true. They don't make lending decisions. When paid, the bad debt will be removed from my credit file. No. Negative history remains on file for the allowable time. So again, those bad judgments, liens, bankruptcies, they're going to be on there for as long as they're allowed to be on there. So you can't take those off, and they're not going to be removed until the time is allowed. Keeping your credit in check. So one of the things you need to do is you'll need to live within your income. So that's a basic rule. Try to avoid impulse spending. If expenses exceed your income, you have 3 choices. You could increase your income, reduce your expenses, or you can go into debt. Let's not do that one. If your income exceeds your expenses, the extra money can be added to savings or used for other purposes, such as paying down debt. So if, for instance, you get a new raise and it's, it doesn't even have to be that much. Maybe it's an extra $20 a month. Take that extra $20 and put it towards, instead of making the minimum payment on that credit card, pay a little bit more, or put it in a savings account. Set it aside so you can make a large payment down the road. That would be helpful. Reestablishing your credit. Stability, that shows that stability will be your employment, your payments, maintaining your mortgage or rent. That's one way to reestablish your credit. Having patience, it does take time. So don't expect things to be don't expect things to be gone overnight. And that also goes with establishing employment. making payments on time, maintaining a residence. So if you know someone who's constantly hopping around from different apartments all the time, looking for that lower rent just to be looking for the lower rent, or maybe they don't like the location anymore over something kind of trivial, try to see if they'll just stay where they are. If it's not, anything, if they're not leaving for something, horrible, then they need to stay and they need to be established. And remember that reestablishing your credit, you want to be slow and steady. You just want to tackle one thing at a time. So even if you find something on your credit report, you find more than one thing on your credit report that is wrong, you should tackle one thing at a time. You should tackle paying off credit cards one at a time, not try to just, of course, make minimum payments where you can, but then try to tackle paying off one, focus it. And we're going to talk about debt repayment next. Apply for secured accounts, like a loan or credit card secured by a small savings account. This is great for someone who is establishing credit. If you've got that teenager in your life who's about to head out the door and go to college, if they have a secured credit card, then that would help them establish their credit faster. And consider the pros and cons of debt settlements. One pro is that debt settlement may help you pay off your debt for much less than you owe. On the other side of it, it will impact your credit and it could be on there for quite a while. So just kind of think about what you want to do to make things better when it comes to your credit. Debt repayment. These first two are pretty fun to talk about. I think it's because of the name. So debt snowball. What you're going to do here is you're going to pay the minimum payment on everything, and then anything extra goes to the smallest balance. So regardless of the interest rate, if you have a card that only has $200 as opposed to the one that has $500 and might have higher interest, and so you're having higher charges and interest every month, you're going to focus on the lower balance and pay that one off faster. And I kind of like that idea. And the last time I talked about this, someone else mentioned the fact that you get that immediate, oh, it's paid off. I'm so glad it's done. And then you can move on to those other cards. Then there's the debt avalanche. This means paying the minimum payment on everything, and then anything extra goes to the highest interest rate. So despite the balance, you're going to be focused on that card with the higher interest rate, which it'll probably take a little bit longer to pay this off because you're fighting against that higher interest rate. But the more you get that paid down, those interest rate charges will go down as well. So that's one thing you can do when it comes to debt repayment. And debt repayment does play a big role in your credit. Think about consolidating your credit cards, but watch out for fees when it comes to balance transfers. If you look at it and you go, oh, 0% interest for 12 months. Hold on. So if you're looking at 0% interest for 12 months and you're making these card transfers, if at the end of the 12 months you still have a large amount of debt, you're going to be hit with interest. And you're going to be in the same situation you're in before you consolidated those cards. If you haven't already, you should stop using credit cards and other debt to finance living expenses. And I think of this in the terms that, if you're in between paychecks, whether you get paid twice a month, once a week, or once a month, if you're whipping out that credit card to try to make ends meet, then you're in an unhealthy cycle of debt. And you need to try to stop doing that as quickly as possible. Try to get extra money to pay off your debt. So maybe a second or third job for some people. Ask for lower interest rates. I always think it's kind of funny when I see this on the screen, because for me, if someone said, ask for lower interest rates, what bank is going to give me a lower interest rate? Always remember, it never hurts to ask. The answer is yes or no, or maybe a little. If you really think about it, they may not be willing to bring your interest rate way down, but if they just brought it down a little bit, it would be really helpful. And there are companies out there that will do that. So another thing we're going to talk about is building wealth today. Do you have any financial goals? Maybe you haven't thought about it. Maybe you're not sure what a financial goal should be. Let's take a look at how everyone has stacked up. Some of you say yes, and some of you say you haven't even thought about it. I know that probably I have financial goals that I didn't realize were financial goals. Making new additions to my house, like a deck in the backyard. In my mind, that's a physical addition to my home, but financially, it's a goal because it would be better if I saved the money to just pay upfront cost and be done with it. So what does building wealth mean to you? Maybe it means the house on the hill. Maybe it means the new cell phone, having cash in your pocket, or a fancy car. But for some, it means paying your mortgage on time. It means having money for unexpected expenses. It means saving for retirement. There's lots of little things that go into retirement in order for it to actually happen and for you to retire happily. So when we're talking about building wealth, the first thing you do is you determine your net worth. Anything you or business owns that has commercial or exchange value is an asset. Liabilities include money an individual or organization owes, which is the same as your debt. And the difference between those two is your net worth. You might be thinking, I don't have any net worth. Well, is your car paid off? If you have a car that's paid off, that goes into your net worth. And here's the balance sheet with that as an example. I know that the market value of my car is not $14,000 because the one we have paid off is a 2012 Mazda. But a lot of times when I look at it, it's anywhere between $3,000 to $6,000. That's what it's worth. So that's not bad. That's still a plus on my side. So you see on this chart that you're going to take your assets and you're going to subtract your liabilities, and that's your net worth. So you might be thinking, oh, I don't have any net worth. How do I build wealth? Just take a second, look over the different things in your life, look at something like this, and it'll kind of help you realize that, you do have some net worth. You also want to set goals. When it comes to building wealth, you need goals. You need short-term goals, long-term goals, and intermediate goals. Short-term goals take less than a year. So we're thinking like an emergency savings account, small household repairs, maybe a weekend getaway. Intermediate goals take 1 to 4 years, like a down payment on a vehicle, an extended vacation. Maybe that sounds lovely. Major home repairs, like I mentioned, a deck. I know the last time we did this at our old house, it was quite an expense, even with my husband doing the work. Long-term goals will include, those are 4 years or longer, and that's going to include things like a down payment on a house and retirement. Retirement is a long-term goal. So when you're going to budget plus your goals, and that equals building wealth. You want to achieve your financial goals. This is a big one. This goes with credit. This goes with budgeting. This goes with financial success. This goes with building wealth. Having financial goals and figuring out a way to achieve them will make you feel really good about yourself. You want to write them down and make them visible and be specific and achievable. So I have mine posted by my door. And this way, every time I go in and out of the door, I see my financial goals, and that keeps me on track. it helps me go, oh no, I really don't need that new, fancy pan to make just a certain type of biscuit, kind of thing. Because it is the holidays, so all of us are, some of us are probably baking more than we normally. And, especially with the pandemic and people still working from home, baking seems to be really popular. So you just got to be able to say no. So if you see those financial goals somewhere, you're going to say, no, I do not need whatever that is. That's going to keep me farther from my financial goal. How much will it cost? And we're not talking about money. You're talking about your support system. You're talking about the sacrifices that are going to be made in order to get to your financial goal. And you want to communicate your goals. You want to rank them and share them with your family members. If my financial goals are not the same financial goals as my husband, how am I going to make sure that we're on the same path? You want to establish a timeline. You want to do this in order to determine where in your budget you need to cut costs in order to save the money. And you want to be flexible and keep your eye on the prize. You may have to reset and compromise, but a setback does not mean you're unsuccessful. And you might go, oh, okay, thanks. But it's true. If you have an emergency, we had an emergency, the end of this year is not being kind to us with our elderly pets. And so we've had some financial emergencies when it comes to their health. And so it's not a setback, though, to our other financial goals, because I know that they're just small hurdles that we need to get over in order to get to the bigger picture. So you just have to reset and take care of those things. So one thing about having really good credit and establishing credit and working towards having really, really good credit is giving you consumer confidence. We purchased a bigger SUV this year because our kids aren't getting smaller. And I know what my credit report looks like. I know what my credit score looks like. I know what my husband looks like. I didn't include him on this vehicle, but if I had, it wouldn't have made any difference. We have great scores and great reports. And so when I walked into the dealership, and they like to say, so let's send this out and see how you do, And I said, no, I'm good. I said, I know how I do. And I do good. I do great. And I don't need you to figure out what I need. I need you to come up with a price that I'm willing to pay for your vehicle in order to leave with it today. And that's what we focused on. We didn't focus on whether or not I have a good credit score and what my financing terms are going to look like. We focused on what I was willing to pay them for the vehicle. And I found out recently when I was finding old paperwork for the other car, which was smaller and older, we paid less for the newer vehicle than we did for the older one. It's going to, like I said, save you money. See? Save money and by helping to lower your rates. So I save money buying a bigger vehicle, a newer vehicle, compared to what I had previously purchased because my credit score looks great. It helps by working towards your credit goals, your financial goals, you're going to heal your credit score and raise it, hopefully. It's going to save you time and stress, like when you're making big purchases, like a new vehicle, and it's going to help you take control of your finances. Instead of going to the dealership right away, I'd already gone to my bank. And I said, what should I do? What can I qualify for? And, they kind of gave me some guidelines, and then I went and bought a new car. And so, but I was completely in control. I knew exactly what I wanted and what I was willing to take. And so all of those things when it comes to, working on your credit, making sure you have a good credit score and good credit history, those are all going to help you with your financial confidence and your financial fitness. And it's going to help, hopefully, to, help with any financial stress you might have. So that's the end of the presentation today. Again, my name is Andrea Johnson. I'm the Financial Education Coordinator for the Office of Consumer Credit Commissioner. If you have any questions or if you've had problems downloading those handouts, you can email financial-education@occc.texas.gov. You can also find us on Facebook at Texas Financial Education Endowment and on Twitter at Financial Ed Texas. I'm very proud of both of those. Next week, I'm going to be going over credit and saving for young adults. So school year is out for the holidays next week, definitely. If you've got a young teenager in your house, a young adult, have them sign up. They can go to our website, occc.texas.gov, and it's under the consumer education page. There's a calendar listed, and I would love for them to attend and their friends to attend. It's going to be pretty basic credit and saving money. Why do you need a credit report, a good credit score, and what's the basic ways to start saving money for your future. So I hope everyone enjoyed today's presentation, and I hope to see some people next week, and happy holidays, everyone.